All right. All right, so we should be live right now. Welcome to the live stream. We don't have nobody in here yet, but we are going to be talking about the stock market, the economy, Fed policy, and crypto, basically about crypto. And the reason why, I know this is kind of lagging a little bit. The reason why this is so important for most people is we've been in this long bear market. We've been in this this fear of high inflation, higher for longer. And a lot of people don't know where to invest. They would recently we've learned that the central banks basically print a lot of money. The US Treasury prints a lot of money, and prices go higher. So how do you defeat that? How do you actually defeat prices going higher, right? How do you overcome that? Because the baby boomers did pretty well, but going into it, if you're a millennial, if you are a Gen Z, prices are just so high for property, right? For the stock market, food, all that stuff. Before, you could live off a wage, right? You could have a whole family with just one person working a regular job, middle class. You cannot do that anymore. And that's kind of where we're coming from, is why can't we do that? And a lot of it has to do with policy. And the only way to overcome that is going to be asset prices, is actually investing in asset prices. And a lot of people just don't know that. They do head for real estate, but real estate doesn't you have to buy a lot of houses. I don't know. Are you muted?
Yeah, I'm here though.
Oh, okay, you're here. I'm just making sure. So you got to buy a lot of houses. You got to do this, but a lot of people don't have $50,000-$100,000 just to do that. So if you're millennial, if you're Gen Z, this is your opportunity. And we're gonna go over this macro newsletter that I write about stock market, crypto, right? Investing, and I'm very bullish on the market. So let me pull this up so we can see it, so we can get going here. Make sure it's got the StreamYard correct. There we go. I'll put us at the bottom. I think that should work. So, we got two bulls fighting here, and I'm extremely bullish, right? I'm extremely bullish on the market, and there's a reason why. Now, why be so bullish in the first place? Like, what is the point in being, bullish on the market, or why should you be excited about that? Because you're probably being told the recession is here, right? Be cautious, don't get in. But there's a trick. There's literally a cheat code to the markets right now. There's a cheat code to bring wealth to your future. Okay, there's a cheat code to that, and we're gonna touch upon it just a little bit. But for the most part, I'm extremely bullish on the market. The macro is starting to turn, and you might hear inflation is high, inflation is really bad, but it's really not. The market is turning up. We're making all-time highs in a lot of stocks, a lot of big stocks. We're seeing all-time highs, and we're starting to see a lot of risk on behavior, right? So the beginning of this is basically the bear market is over, right? This is my thesis. The bear market is over, and the next major pullback will kick off wave 2 FOMO from higher lows. I'm sorry, lower highs from here. So lower highs from here. Now, just to kind of, what are we speaking of here? If we look at the S&P 500, this is the S&P 500. I think this is fitting the graph pretty well. Let me make sure that's good. Yeah, looking at the S&P 500, right? A lot of people were bearish down here. And if you are familiar with investing, then you kind of know what this chart is. This is the stock market, right? This is the stock market. You make more money in the stock market than investing in gold. You make more money than real estate. Real estate just doesn't, as much as you hear it, it might be easier to do real estate because you just do it for a long time. I don't think it's easier at all. You just make one purchase in the stock market. Your 401ks, your pensions are tied to it, blah, 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 XYZ, right? So
Well, one thing I've heard about the S&P though is, are you actually really up when you compare it to M2 and you compare it to growth? Are you even up in the first place? Some of the things I've heard are you're not actually up on the S&P when you compare it to M2 relative where the S&P was in the 80s and the 90s and things like that.
Yeah, no, you're not. Because the Fed balance sheet is, see if I can pull it up here. The Fed's balance sheet is exploding pretty much over the last, 20 years. So Fed balance, let's see if we could pull it up right here. Fed balance sheet might be one of these. Um, this is global. Well, this is liquidity right here. This is liquidity, but it's pretty much the same thing. So if you look here, right, if you measure these things right here in the orange, that is basically the Fed liquidity. And a lot of people don't understand. This is why this is the cheat code, guys. This is the cheat code. This is the cheat code to actually, not like day trading. We're not talking day trading, swing trading, but the cheat code for 18-month cycles is this right here. This is liquidity. This is where the trillions of dollars come out of the central banks and they go into the market. And the problem is the S&P 500. Now, I don't have it marked on here, is not above this balance sheet. So the S&P is returning maybe 5, 10, 15% a year on average over 10 years. But the Fed's balance sheet, it's not measuring up to that. And this started in 08. So just to keep, this is the most important point, by the way. If you're watching the stream, this is the most important point to the whole stream over the next 18 months. I think markets go to all-time highs. Tesla, Bitcoin, crypto, AI, you hear all this stuff. All this money is coming from this concept, right? And it's going to pump asset prices. You're not going to make money anywhere else other than assets, right? Your wages will never be enough because your prices of food, the price of energy, the price of shelter, it's all going to climb at the same pace or if not faster than your wages. Plus you have to spend your wages. It's not like they all go to savings, right? So this concept of Fed liquidity or, central bank balance sheets going higher, this just liquidity is the cheat code. And we're going to go over that. And remember this cheat code, we're looking here. This started in 2008. So this just barely started. Everybody compares us to 2001, 2008. We didn't start this till 08. So now this is in play. Now this Fed balance sheet, right? And this isn't really balance sheet. This is liquidity. Liquidity is in play. So we can predict what is going to happen next in the markets because most of it is liquidity. So let's get to the markets real quick. We're extremely bullish here. All right. And what I'm basically saying is from here, so let's zoom in a little bit. I'll take this off. From here, I just think we make lower highs. Okay, I'm gonna go to the daily charts. If you're not familiar with charts, or maybe you are, you know that charts are basically the reflection of market participant behavior. And we've been, since October, this was the October low when everybody was fearful, everything's falling apart. We've been making higher lows, higher, higher, higher. We're climbing higher. And nobody believed we can get over this. Nobody believed that we could get above this 4,200 level. And we smashed through it. And I said, hey, there's a short squeeze on hand. We're going to see a short squeeze if we get above 4,200. And we saw that. Now we're at the top of the trend. So we're moving higher. But base case here, let's go over the economy, stock market. Let's see what's going on here. First on, we're seeing a lot of risk on behavior here. So this is the S&P 500 market breadth. People call it market breadth. And what it is the cumulative advanced decline line at top S&P 500. So the stock market, and on the bottom is how many stocks are advancing versus declining, right? How many are advancing versus declining? It's basically advance minus decline. And we see that this advanced decline line is almost at an all-time high. It's pressing all-time highs while the market is not there yet. So there's an argument here, a recessionary argument that, there's an argument that the market doesn't have enough breadth, right? Everybody's negative because, the only 7 stocks are moving the market. But this reflects the opposite. This reflects that there is market breadth. It is S&P 500, but it is market breadth in the S&P 500. We're seeing movements. We're seeing more stocks advance versus decline. So when you hear that narrative, there's there's not enough market breadth. No, that's not true. So that is kind of the begin, or that is just one indication or one signal that the markets are going to keep going. If this breaks out, it's basically telling us the overall market is just going to keep climbing. Okay, next, and we'll run through this so we can get to the actual picks, top 5 picks, and go through the technologies. If you guys want to hear about what we think on crypto, Tesla, what are the best what is the best bets over the next 18 months? Probably the next 5 to 10 years, but definitely over the next 18 months. Okay. So another one of these is volatility. Another one of these signals that we're going much higher is volatility. Volatility reflects the confidence of risk taking. If volatility is up, then people are not taking as much risk in the markets because they're afraid, and that's NASDAQ, right? That stands for crypto. This is S&P 500, and this is bond volatility. And this basically represents, when it's going higher anyways.
Why do you say the NASDAQ stands for crypto?
Did I say that?
Yeah, you said it stands for crypto.
Oh, okay. NASDAQ stands for technology. My bad. That was a mistake.
Oh, okay.
So NASDAQ is definitely for technology stocks, Apple, Amazon, Google, Facebook, Tesla, Nvidia, AMD, all those tech stocks. The big mega caps are basically what NASDAQ stands for. So you see the volatility or the insurance against technology is coming down. It's been coming down for a while now. And same thing for the S&P, that volatility is breaking a new lows. That's always a sign of a new secular bull market. What is a secular bull market? Secular means like the next 8 to 10 years. If you want to make it practical, it just means like over the long run, right? So once you get to these lows, once you start breaking lower, it's a signal that, hey, we're back into a bull market. And bond volatility, this is actually the worst bond volatility right here that we've seen, I think, ever. I think this is the biggest move in the bond market we've ever seen because of the high inflation, because the Fed hiked rates at the fastest pace ever. That's very confusing to most people. We can dive deeper into that maybe later into the future. But the real point to get here is that why are people not buying insurance? Why is volatility coming down? Even though you hear, oh, there's a recession and stocks are going to crumble, the Fed's going to keep hiking, Ukraine, the nuclear war, all this stuff. Sure, that's a black swan. It could happen, but why is volatility not going up then? Why are people not betting against the stock market? Why are people not betting against the bond market? Well, the question is, why buy insurance when the market risks, inflation, and recession are continuing to ease? And we're going to get to that. We're going to get to the macroeconomics of inflation and recession so you can understand why volatility continues to come down. And there's actually something really key about bond volatility coming down that is very, very bullish for the market. Maybe if we get to it, we'll get to it. But it's kind of complicated. We'll stick to this for now. All right. So like I said, the biggest thing here is that liquidity is starting to rise. And stop me if you have any questions, if something is a little confusing. I don't know if we have anybody in the chat. No, we don't have anybody in the chat yet. But if you have a question, throw the chat up. I'm going to rush through this as simple as I can. If it gets too complicated, my brother will stop me here. All right. But basically, it doesn't matter, right? You need to keep this in mind. It doesn't matter what your thesis is. We're bearish, we're bullish. We're going to have a pullback to 4,200. Oh my God. Student loan debt is due next. It doesn't matter when liquidity is rising. When liquidity is rising, it doesn't matter what your thesis is. The market is going higher. Okay. Now,
and liquidity, you're talking about the money printer, right? You're talking about more cowbell.
Yes, more cowbell. Liquidity is the how much cash is going into the system versus leaving the system. Cash, cash, because it doesn't matter if it's from China yuan, if it's Russian rubles. It doesn't matter if it's India. I don't even know what the India is. Mexican pesos. Nobody really cares about that though. It's all about the dollar, right? We know this. You hear that narrative. I know you hear about the dollar all the time, like. The dollar's going to zero. The dollar's going to fall. And this has something to do with liquidity. The dollar's going to zero. We're being taken over by BRICS. No, I don't think so. That's false. That's a false narrative. It's not happening. The dollar is 75% of transactions globally. It's most of debt in the world. Most country. If you're in another country, you don't want Chinese yuan. You don't want freaking Russian rubles. You want dollars at the end of the day. People make that argument, but yet they would never hold another currency because it can be debased. We have the best system either way. So liquidity, what it stands for, and let me throw the chart up there. Liquidity this is net Fed liquidity. So this is just focusing on here in this, I guess, what color is that? Green, not green, blue, like a
turquoise. I don't know.
Turquoise, whatever, a bright turquoise.
This is the Fed. This isn't the Treasury. This is Fed.
This is, well, it kind of is. They're kind of the same thing. But this is the Fed. This is basically the Fed's net liquidity. And we'll go over what that is. But just to get the concept, you're seeing NASDAQ, right? NASDAQ was in a downtrend for a while. Bitcoin was going lower. Oh, liquidity was going lower at the same time. So they kind of match. Liquidity bottomed. I guess it bottomed here in 2023 in January, right? So liquidity bottomed. And what I'm trying to highlight here is as liquidity started to rise again from the bottom, we saw Bitcoin rise, we saw NASDAQ rise, and then the second leg of liquidity goes up. This was the banking crisis, by the way. This is BTFP. By the I'm just kidding. By the F and dip is what people say when this happens. But the truth is it's bank term funding program. So this is an excuse or a concept to pump liquidity into the markets to save the banks. The regional banks basically almost failed. And they came up with a program, 450 billion. This is probably the biggest liquidity rise that we've seen so far in this cycle. And that was the bank term funding program, $450 billion of Fed liquidity. So they basically purchased, to make it simple, they pumped money printer. They pumped dollars or cash into the system to back the banks from failing completely, right? So that's what that was. And what do we see? We saw Bitcoin jump. You saw NASDAQ hasn't even came down yet. NASDAQ pretty much exploded. And a lot of that was because of AI too, because of the AI theme. And maybe we'll get into that. But what is this Fed net liquidity? Just so we know, some of you guys that are a little more, you want to know the technical definition. This is the Fed's balance sheet minus the TGA. So this is the Treasury General Account, and that's what's supposed to be bearish about the market now. So the Fed's balance sheet, basically the assets that they swallow, which pushes cash into the system, the more the balance sheet goes up, that's basically them swiping their credit card and putting credit into the system. So that minus the Treasury General Account, which is the US Treasury spending account, and then plus overnight repo. This is really confusing. I'll show you a little more of what that really means. But to make it simple, net liquidity is the Fed's balance sheet minus TGA plus reverse repo. Okay. Probably doesn't make any sense to most people, but we can get onto that on this next chart that we are on this other chart, right? So reverse repo liquidity is fueling the risk assets. We just said, what is reverse repo? What the hell is reverse repo? What people need to understand, this is reverse repo, by the way, this blue line, okay? Going back to, so if you guys were in crypto or if you guys were in the stock market and you saw, remember ARK Invest and crypto peaked back in like April. I know Bitcoin did a double top. It went up to, 64, 65K, and then it went to 69, but it pretty much double topped. If we look at the actual, price of Bitcoin or ARK, right? If we go back a little bit, we see that this right here was basically a double top. Yeah, it went higher, but if we look at the RSI on the weekly, let's look at the weekly RSI. If we go to the weekly RSI, it's pretty clear that Bitcoin was not pressing higher, right? The RSI, let me move that over so we can see the RSI was moving lower. So buying pressure was actually falling, right? While we made a new high. If you're a trader, if you're more technical, you know that that's bearish. So why was this the peak? Why was this the peak? And this is the answer for
Is it
Bitcoin.
because the Fed? Is it because the Fed said they were going to start raising rates?
I think it was actually before the Fed said this. At this point, look at this. Let me just show this real quick. At that same point, ARK, so the riskiest assets peaked first. The riskiest assets, crypto and ARK Invest, right? Innovation Fund. We love Kathy Wood. We tripled. And then they hate Kathy Wood because now we're down, 90%. That was not the case for the NASDAQ. The NASDAQ actually peaked a little later. So this was that peak. The NASDAQ still kept going up. The S&P was still going up. But why were the riskier assets why did they slow down? And that's the question that we're answering here, because in the reverse, they're going to go up the most. And that's kind of what we're signaling here, right? Now, what happened is April in 2021, when crypto peaked, when Bitcoin peaked, when Ethereum peaked, yeah, they double top, whatever. But that first peak, that first blow off top where ARK peaked, you actually had liquidity leaving the market and going into the reverse repo. What is a reverse repo? It's basically this account where cash where you can collect interest on your cash. You park, to make it simple, this is the Fed's facility. So the Federal Reserve, the most powerful entity in the world, right? Like they are super sane when it comes to, they run the markets. Let's just put it that way. Okay. I don't even know if that was the right thing, but the Fed's reverse repo is this facility where you can park your cash and receive money, receive interest on your cash. Sounds familiar. Money market funds, right? Everybody's getting 5%. Well, that's exactly what it's happening right now. So it started back when inflation, this was actually April 2021, when inflation jumped above 2%. We all know the 2% target is what the Fed wants to see. And this was the time, I think inflation was at 2.1 or 1.8, 2.8. But once April hit, you see this red line is inflation. Inflation started exploding. And as soon as it exploded, you saw the reverse repo go up, because what that means is people are like, oh, shoot, this is a risk, right? Inflation just broke out of like a 20 years, 20-year high or whatever. Up here is like 40 years, but inflation is starting to break out, and we know it because the Fed just printed a bunch of money. So inflation's going higher. So people took their cash, or institutions, whoever it is, they parked their cash inside that reverse repo because it's risk off. It's basically, let's take some risk off the table. So the first assets to fall off the table were risk. They're sensitive to risk off conditions, right? So you saw the reverse repo start to rise right after inflation just kept going up. This was April, and that marks basically risk assets peak, ARK and crypto. Some of the stock market kept going up, but the reverse repo started to climb. And by the way, this is the biggest climb in the reverse repo in history. So
someone's asking what happened with TikTok.
Yo, what up? What happened with the? I know it's confusing. Hey, if you ask a specific question. No, wait, did my mouse just go out? Bro, you got to be kidding me. This mouse just ran out of juice. Let me charge it while we're waiting. Damn it. This is really gonna piss me off. It's all right. I don't need to. Damn it, this
I mean,
happened yesterday.
I could tell him that we got banned from TikTok for a week
Yeah, we got banned for a week on TikTok,
for
bro.
hateful. We said hateful and discriminating content, even though it's a finance channel. They said we're discriminating. So that's how TikTok is. Very, very strange rules there.
Yeah. Either way, bro, we'll be on here for a week. The charts are a lot easier to go through, but we're going through this Fed balance sheet. I'm sorry, this macro report. So yeah, if you have specific questions, I didn't even know somebody said confusing. It is confusing, which is why I'm here to simplify it. It's gonna sound a little complicated to get the details in, but to simplify it, basically, we're risk assets are on fire right now. So let me finish this off. Let me let me just jump through this really quick. Reverse repo went higher. So cash is leaving the system. That's what this is. Cash or liquidity is leaving the stock market as inflation climbs, right? Inflation is climbing, cash is leaving. Why? It's risky. It's going to crash the market. Prices are going higher. People are going to sell their stocks. They're looking forward and saying, oh my gosh, 50-year high inflation, everything's going to crash. So you're getting that money going to the reverse repo. Now, as the reverse repo was going up, it was also more profitable. We saw the dollar go up because dollars became more valuable because you're fearful, right? You're scared. You're fearful that the markets are going to crash. So you sell everything into dollars, and that's what we're seeing. And if you have those dollars, you might as well make interest on them, right? Not at the bank. The banks are going to give you no interest, so you park it in the reverse repo, and that's exactly what people did. So the reverse repo kept going up, and the reverse repo is also tied to the interest rates, right? To the Fed funds rate. You hear, oh, Jerome Powell's hiking rates. Well, those rates, whatever the level of those rates are, is what the reverse repo is basically paying you on your interest. So it actually helps for the Fed to increase rates. It actually helps your cash if it's parked in the reverse repo, which money market funds do. So they're getting paid while inflation goes up. And that's why this thing kept going higher. Now, eventually, we saw headline CPI peak. That was October. Actually, it peaked in the summertime, right? It started peaking in the summertime. Some investors got a little bullish, but you don't know until like a month after that it actually peaked, like the trend actually broke. And then eventually in January, this is when the bull market really started. Reverse repo peaked. Well, why? Why did the reverse repo peak? Because inflation was now decelerating. This is number two. We're now decelerating to the downside in inflation. So it's kind of clear that the biggest risk in the market is inflation, and now it's starting to disappear. So people are now getting more risky, and we saw the stock market bottom in October, and now they're buying back in January even further. So the RRP, or the reverse repo liquidity, peaked, stocks started to break out, and inflation is falling. So that all makes sense. That whole narrative, that's it. 1, 2, 3, right? We saw that. Now the reverse repo kept going up because people are still, they're worried, they're fearful, right? The economy is going to collapse. Is what you're explaining happening now? Yes, this is no, this was the past. This was the past. We're getting to now. We're getting to June. We're in June, right? We're still in June, right? We're in June right now. So we're getting to June. This is just the history. Yasin, I feel like your name is Yasin. And what?
No, it is. He says he's Yasin from TikTok.
Oh, what up, Yasin? Shout out to Yasin. What's going on,
Also,
bro? We're
you can't really
hear
your thing in the background, Jeremy. But I would keep doing it anyway. It's pretty funny.
Oh, you can't hear it?
You barely can hear it, but just keep doing it. Who cares?
Stupid. Damn. Okay. All right. Well, I'll push it anyway. Anyway, yeah, Yasin. So we're getting to where we are now. The whole moral of the story is the RRP facility, or all that cash and liquidity, is starting to dump. It's starting to roll over. And where is it headed? It's headed into the market. It's headed into crypto. It's headed into technology stocks more than anything, because they solve a lot of the problems. And as inflation abates, as we see inflation fall like a rock here in the red, the CPI, right? This is CPI headline inflation. As it falls like a rock, the risks to the market fall apart. The only risk you really have is growth collapsing, but we're not seeing that. We're not seeing growth collapse at all. They had their, growth could have collapsed when the banking, we're going to get to the banks. It could have collapsed when the banks collapsed, but it didn't happen because the Fed stepped in with more liquidity. I know this is confusing, but stick with me here, right? So we're in June. We're in June right now. And what are we seeing? The market just broke out. So June, right? That is this is June right here, where we started the end. It was really the end of May when we broke out of this level. This was the monster the iron condor level, which I called it. Everybody said, it's not going to happen. I said, hey, we're going to get a short squeeze if we get over this level, because you have a record You have a record short positioning, 15-year high short positioning in S&P. Everybody was believing that the S&P was going to go back to the lows. So when positioning is that bad and that negative, you have a chance to squeeze higher if they're wrong. And I thought they would be wrong because inflation keeps falling and risk is coming on the table. We saw the VIX and the volatility keep falling. And that was basically the case. So now we're in June. And the reason I have this line here, I'm sorry, did I back out of that? The reason I have that line there, I'll get back to it, is because the hell? That line there is because we're starting to see technically the reverse repo liquidity rollover. It is now breaking to the downside. So we can now guess as it went up, now it's going to start going down. Where does that cash go? That cash is going to go into risk. And so what do we see now? We're seeing Bitcoin go higher. So anyway, CPI is falling, right? That's another reason why people are leaving the market. Now, there's actually a really good reason. The TGA, I'm going to try to explain this. There's a real reason why this RRP is leaving the facility. The reason that we're seeing less liquidity in the RRP or in the Fed's facility, they're leaving the facility and they're going into stocks. They're going into Amazon, Nvidia, Apple, all-time highs, right? Bitcoin's starting to explode. Tesla's been going up 100%. So there's a reason for that, even though you hear the bearishness about it. CPI is falling. We're now in restrictive territory. A lot of investors just wanted to see inflation below 5% or below the Fed funds rate. Okay. So now it is. We're at 4%. Guess what? Next week, we're probably going to be lower, bro. We're going to be a little lower, right? Thank goodness. Can you guys hear that? Could you hear that? So barely. Okay. Well, we'll fix it. We'll figure it out. Inflation is falling like a rock. Okay. It is falling like a rock. And I'm going to show you, we're going to get to why it just keeps falling. Anyways, recession fears are starting to ease. We're seeing, and we're going to get to that too. Liquidity is leaving the RRP. It's leaving the Fed's facility and entering risk assets. S&P's breaking out. Qs are breaking out. Bitcoin's breaking out. Okay. Really quick. Let me see. H-Rod. Hey, what up, H-Rod? I'm going to share the live with the other people. Hey, appreciate it. That Forex, that trade Forex. Yeah. And if you guys got questions, we can jump back on it because I'm telling you, this is a very bullish market and your best trade in Forex, if you're not 100x leverage, is going to be Bitcoin. We'll get to that though. All right. So now the reason I said liquidity is the most important thing, first of all, is because markets only move with liquidity, right? They need liquidity. I know rates are high. They're at 5%, but it's really the rates that you really need to come down. Or I'm sorry, it doesn't matter if rates are at 5% if there's more Fed liquidity coming in the market, right? Like we said, it's rising. Net liquidity is rising. So even with rates higher, we're still getting more liquidity because, essentially governments can't work without more liquidity. The whole economy collapses. They don't want it to happen. So they're holding rates higher while still doing QE. Okay. Now, the reason this RRP is falling really quick, you guys hear the best argument against the market right now that the market's going lower is because the treasury are, you guys remember the debt ceiling, right? The debt ceiling crisis. Well, the debt ceiling was they're going to create more debt and they're going to offload it onto the market. And that's going to push rates higher because you create more US treasuries and you offload them. Well, what's happening is this RRP facility is actually eating up those damn rates. The RRP, people are leaving the RRP and they're eating up the treasuries so that the treasuries don't push yields higher. I know that's very complicated, but were you going to say something? But basically what's happening here is the government's Janet Yellen has already said that they're going to start buying back US treasuries. And if they do that, they're basically doing yield curve control. And what that means is that when there's more, when people sell bonds, okay, when people sell bonds, basically you get interest rates climbing. This is the 10-year rate, right? This thing exploded. This is another reason why the market really pulled back, because the cost of money went higher. So when you offload more US treasuries, this is the 10-year, then the treasury yield or the interest rate for the markets goes higher. Now, the fear is they're going to keep creating more debt. That was the debt ceiling crisis, right? But the opposite happened. They basically raised the debt limit, and we're not seeing rates high, right? Rates didn't explode. They're not moving higher. Yes, the 2-year moved up a little bit. It's basically almost at all-time highs, but the market doesn't care. And the reason that is because all that cash, all that liquidity that was in the RRP is now going into the markets. So it doesn't matter if treasuries stay higher than longer, as long as there's more liquidity, and that's what we're starting to see. And the way that they're getting people to leave the RRP or the facility, this is so smart by the Fed. I didn't even realize this was a thing. I'm listening to this guy explain this. It's super boring. It's really, nerdy. But what's basically happening is you get at the RRP, you're getting, let's say, 5%, right? But what they're doing is the U.S. Treasury is selling 3-month and 6-month, 3 and 6 month bonds or treasuries to they're basically selling them at 5.5%, which means not at 5.5%, but they're selling them and saying, hey, you're going to get 5.5%. So you're going to get more yield off of the U.S. Treasuries that we're creating than you would parking it at the Fed. If you're smart, you're going to go where there's more yield. So that's why this thing is decelerating. That's why cash is coming in the system, because people are saying, holy crap, I'm gonna buy. Why would I hold 5% RRP? Why would I put my cash in there and get 5% in 12 months when I can get 6% or 5.5%? Fact check me. I don't know what the 3 year is at right now, but 3 and 6 months. Let's say it's 6 months, right? I can get 5.5% in 6 months. Why the hell would I not do that? Because in a year, I'm gonna actually get 10% in real terms. So they're leaving the RRP facility, which is pushing liquidity back into the markets, because the Treasury is doing something smart, which is they're selling 3 and 6 month treasuries, not 10 years. Right now, I know that's very complicated, but we're going to do a whole episode on that later, because this is super important to build the argument for the market to go higher. Very
Hey,
confusing.
we're about halfway through the stream and about 1/5 through the post, so we got to go a little faster on the post.
All right, we'll speed it up. We'll speed up from here. I know that was a lot. We'll do a whole nother. I'll do a whole thing on that in the future. All right, so global liquidity is picking up. Here's another part of liquidity, right? China is cutting rates, guys. Very simple. We're holding rates high. China is cutting rates. This is the second largest economy in the world. Okay, so they cut rates, more liquidity into the system. Their loans are increasing, right? So these are loan rates. They're cutting rates on loans. That's more global liquidity coming in, and their economy is not as strong as they wanted it to be. So they're going to keep doing this, right? And what that means is they push more. They're cutting rates, so money supply goes higher, because basically, as they cut rates, well, they're increasing liquidity in their markets too in China. So money growth goes higher. M2, you guys heard of M2? Now, as M2 rises, you're basically getting more liquidity or more cash, but they're not, US dollars into the system. So China's cutting rates. They're also, their money supply literally is going higher. That's another thing that's fueling markets up, right? This is simple, right? Japan, third largest economy, their money supply growth is exploding too. Look at that. We go from July, oh, you can't see my mouse, all the way through April, and April, May, and you see Japan is also their money growth. So where's that coming from? Japan's money growth, or M2, is also exploding. So the second and third largest economies are printing money. Okay. Now they can keep doing this. At least China can, because China's inflation rate is basically zero, guys. The inflation rate is basically at zero. So they can keep printing. Their producer prices, which lead inflation, are at negative. They're almost at negative 5%. So they're going to keep pumping liquidity. China is the whole Asia Pacific area is going to keep pumping. So expect crypto to go higher. They're going to buy US equities. It's going to go higher. Okay. Now, these are the central bank's balance sheets. Remember, this is a macro report, so stay in here. This is the most important thing. These are the liquidity injections from central banks over time. You see, this was the pandemic. The Fed went high. The Fed exploded with liquidity. Japan went higher. And then here in red, I'm sorry, the Fed is yellow. Red is China. China's been increasing liquidity. And once we cut it off, once we stopped, we basically drained our liquidity, monetary tightening. That's when we went into a bear market, because inflation went higher. We're coming down, right? And China is still pumping. So there's still global liquidity coming into the market. And this is why we bottomed so early in October, because the Chinese economy, the second biggest economy, they came out of COVID and they started pumping. Japan, they tapered off for a while, and then they started pumping higher again. While we bottomed, and then we had the crisis, right? The banking crisis, boom, we pumped. I expect this to go higher eventually, but and here's why. Right?
Yasan is saying, if M2 rises, does this mean that currencies go higher?
It doesn't necessarily mean currencies go higher, because M2 is, you're debasing the currency. So what it means is that fiat currencies as a whole, because you measure currencies against each other. I know you guys are Forex traders. So the real question is, which M2 is going higher faster, right? Because China and Japan are printing faster, the Japan's currency is falling. The more they print, the more it falls. Now, I don't think that's a thing to trade off of, because the US is also, well, the US M2 is suppressed, but it's going to go up. So more so than anything, I know you guys are Forex traders. Look at the NASDAQ 100. That thing is going to keep ripping. The NASDAQ 100, I know you guys look at that, because M2 is going up and it's going to funnel into NASDAQ. Currency wise, they're measured against each other. So let's put it this way for simple terms. The more M2 goes up in Japan versus the US, the further the Japanese yuan falls. Is it Japanese yuan? Chinese yuan. What the hell is the Japanese? I don't know.
Yen.
The yen. There you go. The further the Japanese yen falls, because they're printing more of it, they're debasing it, they're devaluing their currency. So their currency falls against the US dollar. As we stay tight and they loosen, their currency falls. So keep that in mind, right? I just don't think that's the best trade here. I think NASDAQ goes higher. But hey, yeah, keep that in mind. So this is why the Fed's liquidity will go higher. Fed liquidity. You guys remember the regional banking crisis, okay? And this is Fed net liquidity again. Well, back in 2020, when the pandemic hit, what did we do? We exploded Fed net liquidity. It exploded right into the market to save the economy. And first it goes through capital markets. And that was a result, or this is just a correlation of the KRE, or this is basically the ETF for the banking for regional banks. It fell apart, and we had more liquidity go up, but it wasn't because this fell apart. This was just a result of the pandemic, right? So what we're seeing again happen is KRE fell, right? It fell because the banking crisis. We can go through. You guys know I don't want to go through all of it. So when regional banks fail, expect the Fed to pump. Right now, we're starting to roll over. So this KRE, this index, is basically the ETF, or the basket of all regional banks, is starting to roll over. Does it continue? Maybe not. But if it does break to new lows, expect Fed net liquidity to rise, to keep rising. That's just one reason. I think it rises anyway, but that's one reason. Okay. Now, here's the other part, the rolling recession, right? Everybody believes we're in this rolling recession. Things are falling apart, but we're actually seeing economic strength in the US right now. We're actually seeing this strength. Let me turn this way so we can see this better. So the US economy is still holding up. It's likely we don't see a real housing crash because no one is selling their house at 3%, right? Just think about it. Who's going to sell? And this, we're on to the economy a little bit. We're going to get to the stock market and crypto, but nobody's selling their house, because why sell at 3% when rates are at 6%? They're just not going to do it. So there's not a whole lot of selling pressure in the housing market. There's some, but there's not a whole lot of it. You don't see it really happening because nobody wants to lock in higher rates, right? Number two, the labor market remains strong, driven by the service economy, and we're going to look at that data. The stock market, as it continues to go up, there's more confidence in people to spend. They're like, oh, shoot, okay, I can borrow against my stocks. That's not necessarily what happens. I know that, there's an argument for inflation, but you have more confidence when your money goes up, when your assets that you're investing in go higher, you get more confidence. Okay. So the housing market, it is the bedrock of the US economy, pretty much, and it's starting to recover. Home builders are starting to become optimistic. So this is the home builder sentiment survey. And basically, we bottomed in December and we've been climbing higher ever since. So home builders are confident about building homes. They see demand, obviously, and sentiment is a very good indicator of what's to come. It looks forward. So these guys, these home builders, they're obviously seeing there's demand to keep building, right? So they're going to keep building, and that's now when it falls, that's a bad signal. So they're going to keep building, right? We saw the largest month over month housing starts, and what housing starts are new residential construction. We saw the biggest jump in May. We're back to level, biggest level since the pandemic, since we printed money. So with that liquidity coming into the market, it's also funneling so much into the economy, but that's not the Fed liquidity. This is fiscal because of the infrastructure bill, right? The White House, or whatever you want to call it, the US Treasury, they did an infrastructure bill. It's $1 trillion bill. And for some reason, right, we're building stuff. Duh. I mean, you put the bill out, you're going to spend all this $1 trillion of money over 5 years or whatever till 2026. And we're starting to see it kick into the economy. So housing starts are going higher. Now, if we zoom out and look at the overall trend, we see that new residential construction projects, which are housing starts, have bottomed. They pretty much bottomed. They're going higher. So we're not seeing the housing market. Maybe prices are rolling over in some regions, but the housing market as a whole is not falling apart.
But since we're seeing all these builders build, it's possible that we get in a oversupply, right? Because everyone's not willing to sell, and then we're releasing new houses in the market. we could get a dilution of supply. That's the only like risk I see if we see that builders, new home builders is increasing.
Exactly, exactly. So that kind of puts us in a bind, which is why I say rolling recession or rolling expansion, because the bind is if you own a home, your home value will decrease because of the new supply. So your prices will go down, but for the people who don't have a home, who are renting or who want to buy a home, that causes them to buy more. So you kind of get this effect where the economy does continue to rise, but it doesn't explode and it doesn't fall apart. So you're just break even. You're just neutral, right? So that's good for new home buyers. But if you haven't bought a home, whatever. And if you haven't, I mean, if you have already a home, then your value might decrease. But that's why I say, hey, buy assets, because your house is not going to appreciate faster than individual stocks, big tech, right? Big tech, crypto, technology. It's not going to increase that high. But so the value of your home, whatever. Now we're seeing this actually support new construction. Building permits are basically people that are registering for permits, not people, they're businesses that are getting permits to keep building. We're seeing that rise. That's in green versus housing starts. So we're seeing that this data is supporting that there's new homes being built, right? So the supply, like the market is not rolling over. People are investing, institutions or businesses are investing in building more houses, which means more jobs, more construction, until AI comes and takes their jobs, whatever, right? I don't even know if that works. We'll figure that out. My mouse doesn't work right now. So on to the home builders ETF. Now, this is the ETF for home builders, okay? Home builder construction. That ETF is exploding. So this is just another reason like sentiment is important, price is important. They always say, well, the economists say, and these traders, it doesn't matter. Price is much smarter than us, and price of the ETF stocks, right? The ETF home construction ETF is almost at all-time highs. And that's a signal that, bro, we're back in a bull market. We're back in a bull market. The housing market is not falling apart. It's just not happening. So that's just another signal. Now, moving on to consumers, okay? Because there's the housing market, there's the consumers. Consumers are not exploding. Like their spending is not going higher. But this is retail sales, by the way. But it's steady, right? We're not negative. You would expect from all the stuff that we've heard that elbow cough, you'd expect that after everything you hear about the market collapsing, that retail sales would be negative. Maybe they do go negative second half. I don't know. But right now, people are still spending money. Where are they spending it? And this is the next chart. They're spending it in services. So this is month over month retail sales, breaking it down into the components. And this is year over year, my bad. And so what we're seeing is that people are buying services, right? Food and beverage. They're going out to eat at restaurants, health and personal care, beauty. You can go look at Elf stock. It's exploding. Watch, look at Elf. This is beauty, right? The Elf stock is exploding because people are taking care, OF. I mean, I can't say it on
So
here.
the beauty will never end.
The beauty industry is not going anywhere. You guys, men are visual creatures and women make the most money off of their beauty. So sorry to say it. I don't care. But services are strong, right? So you got services strong. People are going out to restaurants. We are how do I say it? We're not animals. We like to go out and meet each other. So we might not be buying new furniture, right? You see the durable goods is negative. So durable goods here at the top. We're not buying new furniture. We're not buying new appliances. We're not building new stuff, even though there's homes being built, except for motor vehicles went up. That was a surprising one. But we are, people are buying services. They are fueling the service economy. So that's keeping the economy afloat, which is basically a reflection that we're not going to collapse until this collapses, until services collapse. And guess what? People are not going to stop spending unless they lose their jobs. And we're not seeing that. Jobs are not being lost. Now, the most important component here is gasoline stations are very negative because the oil prices are collapsing. So the cost of gasoline to fuel your cars is falling year over year, which is good because we had inflation last year. So that's giving more confidence for consumers. They're like, oh shoot,
Hey, Yassine, where can you find this on the site? Go to Jeremy's profile in the TikTok bio or mindgrowth.io and just search by last updated or search for Jeremy. It'll be his latest post. So you can find it there. Or you can just search, what's this post called?
it should be the latest post.
Extremely bullish. Extremely bullish. Just search for extremely bullish.
There you go. Extremely bullish. This is a post. Extremely
Yeah.
bullish. All right, I'll try to speed it up. I just really get into it here.
Yes,
So,
we got to speed it up.
okay. So yeah, people are still spending. All right, inflation may collapse. Now I'll go through this really quick. This is basically a chart. We're seeing the ISM PMI manufacturing index. Yassine, you've heard me talk about this many times. The ISM leads the excuse me, the ISM leads the business cycle, and the ISM survey is pointing lower. As a matter of fact, we just got the global PMI, which is a front runner to the ISM, and it went lower. So that's telling us the manufacturing sector is still in recession, and crude that uses a lot of energy. So the more it goes into recession, the more businesses or manufacturing has less demand, the less oil or the less energy they're using. I expect oil to crash. That's basically what that means. That's not just because of this. You also have Russia and you have Iran selling very cheap oil to gain market share against OPEC. Well, they are kind of OPEC, but against Saudi, right? Now, at one point, they were selling oil at $37 a gallon. So they're trying to gain market share. That production war will cause oil to collapse. I expect it to go into the 50s. That decreases inflation expectations. Bull market, right? That's another reason why we're going higher in the markets, because inflation will collapse. Now, the other part of inflation that is sticky is shelter. We all know that, right? Shelter inflation is so sticky, blah, blah, blah. Maybe you don't know this, but this is what's keeping up core inflation. You hear about core so hot. Oh my God. Well, guess what? Shelter is lagging by 12 to 18 months in some cases. And the real-time data from Zillow and Redfin are actually showing shelter prices collapse. So I expect the headline core to collapse by the end of the summer. I think we're at 2.5% headline inflation by the end of the summer. Super bullish for markets. We're going to have a pullback at some point, but I think we just go much higher. Okay. Now, the cost of capital. The only reason bond yields haven't rolled over is because this core inflation. Bond yields are the cost of capital. And this is really the last shoe to drop. To one of the last shoes to drop to kick off more bull risk assets, really, because if it's cheaper to fund growth, then you're going higher, right? So we're looking at core inflation. Expect this to fall. I expect core inflation to fall out as shelter, which is basically rent prices, collapse. Those will collapse, and then finally we'll get bond yields to come back into trend because they actually trend lower over time. That's always been the case. All right, now here we go on to the investments. Okay, on to the investments. These are my top 5 picks, and we're gonna just kind of briefly go over why. We're at 47 minutes. We'll try to briefly go over this. Isaiah, jump in. Actually, I'm going to ask you a little bit about it. First, we got Bitcoin, right? If you watched my newsletter, you know I said, hey, this is a very bullish setup for Bitcoin. We're starting to see, we were starting to see this flag pattern start to form. And let me zoom in here against that 25K level. So we saw the flag pattern, the bull flag form against 25K. And then as soon as we came into 25K and we supported it, which is a break and retest, we got the ETF. We got we don't have it yet because we'd be at 50K if the actual ETF was live. But this is the BlackRock ETF that you've heard about. Now, quickly, let's talk about why this is so bullish for Bitcoin. Because for one, everybody's got denied getting an ETF. Every institution who's filed for an ETF has got denied or hasn't made any progress. But BlackRock is very tied to the government. They're very closely. They're the biggest asset manager in the world. They control about $11 trillion. They do ESG mandates, blah, blah, blah. So maybe the federal government just wanted to use their best friend BlackRock to actually pass the Bitcoin ETF so that all the money could flow through BlackRock instead of through Grayscale or Coinbase or whoever else.
They want the adults in the room. They want the people with maturity, the people who they can trust to start the initial ETF. So I know a lot of people in the crypto community are like, why are they letting BlackRock do it? They want control over it. But all that means is more liquidity is going to come in and it's going to drive innovation in the space. It's going to drive adoption. So in the short term, less decentralization, it's going to be owned by the richest people in the world, retirement funds, but that's more liquidity, more innovation, more network effects. I see it as a positive.
100%. That's a positive. And two, I just want to make sure we get through this. It opens the door for a $35 trillion. This is a Bitcoin guy I was listening to the other day. He said there's the retirement system market is $35 trillion. Not to say it's going to all go into Bitcoin, but just a piece of that, people saying, hey, I want some exposure to Bitcoin, even if it's 1%. Now you have the retirement fund, 401k, pensions open to Bitcoin, which is kind of the thesis. It reduces the volatility, meaning they're not going to sell. Nobody's selling their down 401k till they're 50. So this is tens and tens of years of accumulation automatically through this ETF. Okay. Institutions also that don't want to use private keys. There's a lot of people who just don't want to deal with, getting their private keys and locking them up. Like Isaiah said, they want to be able to trust somebody, not Sam Bankman-Fried and FTX, because you can't trust those guys, right? But you can trust BlackRock. I know they're the federal government, but you could, I mean, basically their best friend, but you can trust them. They're not going to collapse themselves. They're not going to fall apart because they are the Fed, right? Go with where the money is flowing to. So that is the bull case for Bitcoin as of now. That is what's, I think, is starting the new bull market. And that brings us to the next thing, which is Ethereum, right? Ethereum outpaced Bitcoin on the last cycle. I think it does it again. You see this old bull flag. It broke out of that bull flag. We're just starting to break the bull flag. We're just starting to break the bull flag. What is Ethereum? Ethereum is basically the platform for decentralized finance, stable coins, NFTs, metaverse. So anything that you hear in the Web3 area, that is all being done on Ethereum. And I know there's some XRP guys in here, or maybe not in here, but that talk about XRP. And what else? Cardano. What is it? Cardano has no traffic, right? Cardano's not doing smart contracts. They have no traffic.
They're doing smart contracts, but they're more focused on the research end. They haven't really released much. Their network's not even close to being used as much as Solana and the other ones. I don't want to say they're doing no, but they are doing some, but it's nowhere near the amount that's going on in the other layer ones. So a lot of their stuff is just in the research phase, and it's been in the research phase for a long time. Interesting thing though is Cardano moved up as the number one layer 2 in terms of market cap in the past week, which is very interesting. Passed up Solano and Tron and a lot of those, but
okay, I didn't know that. What is it? ADA USD?
88, yeah, ADA.
Okay, this doesn't look right. This is probably the wrong exchange. Okay, so at 30 cents. Well, a lot of cryptos are getting crushed. The whole point is Ethereum by far has the most network activity and adoption. Like Cardano's not even close. So
Yeah, Ethereum's the way to go.
Who do you go with, right? Okay, next is Tesla. And I know, oh my God, Tesla. But look at this wedge pattern, bro. Look at this gigantic. And if you were in the chat on TikTok, you know a lot of the guys who are bearish on Tesla, they just left the chat. Where are they? They're nowhere to be seen because Bitcoin is probably squeezing all their money. They're probably, really sad right now. And they probably lost a lot of money. And either way, Tesla is breaking the bull flag. So this giant bull flag, it is now breaking out of. And the real catalyst for this, let's just go through the catalyst. You're starting to see Ford, GM, Rivian, all these other EV companies basically bow the knee or get on one knee and say, okay, we're going to use your supercharger network. So that's one area of revenue there. The supercharger network is very superior. I believe that it's getting better. Other networks, it takes like 30 minutes to charge your EV. Here, it's like 6 minutes, and it's getting better. It's getting faster, and it charges it faster. It's just more efficient, whatever. So everybody's basically going to be using the supercharger network, which is more revenue for Tesla and more market share. It is the number one selling car in the world now, right? And go look it up. It's the number one. Well, the Model Y is the number one selling car in the world. And then so that's huge. You expect margins to go higher. And that just started. So you got that, and then you got the Cybertruck coming out at the end of this year, right? Cybertruck is coming out. There's already like 1 million. There's a lot of orders for Cybertruck that that cash hasn't even been realized yet in their earnings. And last time they came out with a very good product, and some people might doubt Cybertruck, but you never know. Model Y came out in 2019, and that's when Tesla stock absolutely exploded. You can't see it here, but it actually exploded. And we expect maybe that to happen again, just because everybody shorts and hates Tesla so much. And once they are wrong, once the demand shows up, they get squeezed, they cover their positions, and we go higher. Also, Dojo is their supercomputer that they're looking to lease into the future. This is probably the best AI computer there is, because it has the most data by far for AI, because every car is an AI on the grid. So the network is humongous. And I don't know exactly what they're going to do with it, but that is just something else to keep in mind, is the Dojo network, which is their supercomputer. They make chips. They don't use NVIDIA's chips, by the way. Their chips are more advanced than NVIDIA's, but they're made specifically for EVs. So when you get, when everybody wants to go full self-driving, right, which is next to the autonomous taxi fleet. Once we get to full self-driving, I know people doubt it happens. It's going to happen eventually. In Germany, in China, in India, once you get to full self-driving, there's only going to be one AI chip that can really work for all the cars. It's going to be the Dojo supercomputer chip because nobody else has the data. They're not even close. So that's another, they'll be leasing that out into the future, possibly. And of course, these are what ifs, but the way technology is moving, that's where we're headed. Okay. And then obviously the taxi fleet, nobody's even close to Tesla. That's another reason for Tesla to go higher, because once they do release the autonomous, and I didn't even put robos on here. I didn't even put the robotic labor force on here. There's just so many things in the pipeline for Tesla. Check out the last video on TikTok. So many things in the pipeline. I think it goes to all-time highs this year. Now that I'm looking at it, I think it goes to all-time highs this year, and along with NASDAQ. And so watch out for that. So we're very bullish on that. And the RSI is not even oversold yet. When it goes, it goes. Palantir is that next one. Palantir, pure AI play. This is just pure AI. I'm not the best understanding on AI, like the best guy to. Can you explain Palantir to any degree?
In a simple way, Palantir allows companies to have basically easy access to their data, easy reporting, easy understanding of how their business works. You can understand supply chains and why does a supply chain lagging equal less profit? Why does this many users using this application correlate to this type of revenue growth? It gives you big data tools. And in the AI space, they're currently used for actual military purposes. You can see in the Ukraine war is something that Alex Karp has talked about, that they're using it right now for strategic military positions, knowing where there's going to be strikes, those type of things. And we see it today. I mean, today, right now, one of Russia's groups is converging. They're in Russia right now, about to attack the capital, which is insane, the Wagner group. And you can say, is Palantir involved in that? Well, they're involved with the Russian military, at a standstill. We think a lot of it has to do with the AI technology that Palantir has been deploying, which is very impressive. That's the thing that no one knows about Palantir right now, which is very, on the bullish side of things.
Right. So, as a technical, I'm not a technical person, so there's your technical feed. But on the technical side of the charts, it's finally pulling back, right? We're finally getting that pullback in Palantir. Went up to 17. It got into the 13s. So I know there's still some room to pull back a little bit. I know there's still some room to pull back a little bit, but either way, okay, what's happening here? Either way, where you're getting that pullback. So for a long-term investment, anyways, this is the number one AI play in my view that is not already over $1 trillion, right? The market cap's like 30 billion. I think they do a 10x over the next 5 years. It could be faster than that because we're getting that global liquidity finally starting to run up. And with this AI play, I was wondering how I could invest in AI. This is the best AI play in the market. I'm telling you right now. AI, the actual company ticker AI, is trash. It's a bunch of hype. Palantir is not hype. It's been around for 17 years, 18 years. They've been working with the government. Go watch Amit's. Shout out to Amit. He's probably the best YouTuber on Palantir. He's always coming out with the new news on Palantir, and it is AI. It's hard to understand, but in my view, not financial advice, but kind of, Palantir is the number one AI play, and I think it does a 10x from here over the next 18 months because not only is it the best AI, and it was rated number one AI, by the way, but the global liquidity cycle is turning up. And when it turns up, as we keep printing, everything goes higher. And the best of the best go much higher. Okay. Now for the all-star in the room. Now for the riskiest bet. This is the riskiest bet out of these by far. This is the top 5, right? This is my top 5. You guys wondering, what do I like to invest in? What am I interested in? These are the top 5. This is by far the most risky, but it has the most upside. I do see now my brother, he knows how to explain it a little bit. I think this thing could do a 50x. Okay. I think it could run to $250 if things work out correctly. That's the max. I think it goes to 100 easily. Easily 100 over the next 18 months. It could go to 250. I think if the macro plays out perfect, right? So this is, Chainlink. Now, what is Chainlink? It does 3 things that I know of. He can explain it better, but proof of reserve. So basically, you want to go over proof of reserve, proving that assets are there. What is proof of reserves?
Yeah, it proves that a organization has assets that can meet their liabilities. A lot of the crashes we've seen, FTX, or some of these central bank failures, if you had a daily assertion of their assets, consumers would know whether they're over leveraged, and they could know to pull their money out. But since those attestations happen over the course of a yearly check, or the government just asks when things go wrong, that's when things collapse. So imagine anyone on the planet could know the reserve assets of a company, and you can know, okay, I know that they're covering their liability. Same thing again with FTX is the big example. This is probably going to be the standard over the next 50 years. Is companies are going to have proof of reserve, so we know with banks or financial organizations the assets they have in real time on a daily basis or a 30-minute basis, just in case they go in the red.
Right. So FTX doesn't happen. The collapse doesn't happen. Terra Luna doesn't these things don't happen with this proof of reserves, and it just came out.
They happen, but users are able to, and it's not a massive collapse. It's we know what's going on, and users can make financial decisions. I mean, if you're under, the company's going to fail, but it gives transparency to the system, and when there's transparency, no one's getting screwed.
Right. Okay, so it does happen. Okay. But the point is, it doesn't happen as bad, because instead of finding out 3 months later, oh my God, this company's been underwater, you're finding out the day, right? It's like, I know we say real time, proof of reserves in real time, but I think what I read, it said like 1 day after the end of each day, it's going to report like whether they have the assets to cover their liabilities or not.
Instead of finding out your husband had a whole nother family with 4 kids and has been taking care of them, you find out the day your husband is going with another woman. So I know it's a crude example, but it's like, instead of finding out when everything is bad and it could be as worse as possible, you're finding out when the initial steps happen.
Exactly. So everybody needs proof of reserves. That's one of them. The next one is CCIP, cross-chain interoperability. And this has to do with efficiencies, right? In the banking sector, Swift network. You want to talk a little bit about the Swift network, the biggest central bank messaging system on the planet, using
150 trillion in transactions per year happen on the Swift network. So it's cross-border payments. The Swift network is used every single time we transact with credit cards, usually, or you're sending a payment overseas, wires. So Chainlink is they want to use one integration to interact with the blockchain. So rather than having an integration with Bitcoin, Ethereum, Cardano, Solana, they're going to use Chainlink, and it allows them to hook into the blockchain networks, any blockchain network, through one provider, which is Chainlink. They're in a proof of concept right now. You can even Google that. They just released an article on it. Really big. Think of, I don't know if y'all are tech nerds, but there's TCP, which allows network traffic. It allows you to go to anywhere in the internet. This is CCIP, which the idea is it allows you to go to any blockchain network through Chainlink. So that's the whole thesis behind that.
Right. And just to add on to that a little bit, the all stable coins and tokenization, I know I'm a little optimistic on this, but tokenization in general needs an oracle, and that's what Chainlink provides. So if you're going to tokenize, people say we're going to tokenize real estate, we're going to tokenize this, we're going to tokenize that. Well, in order for that to actually happen, you actually need a mechanism to report real-time data to the blockchain. And by far, Chainlink is the most dominant oracle network to report that data. Almost every single blockchain already uses it for price feeds to reflect what the price of something is. So if you're going to tokenize everything, real estate, blah, blah, you need Chainlink either way, which means it becomes a use case for the whole Web3 space in general. Stable coins, there's other countries who are creating stable coins because their retirement systems, their pension funds, they want to own US equities. And in order to buy US equities, they have to go through this stupid program where their money doesn't settle right away. So they're like, hell no, we're not going to put it in a US broker's hands who could collapse. There's risks there. So we'd rather just do it through a stable coin where the money settles instantly. Well, in order to create the stable coin, they're going to need the Chainlink price feeds, or they're going to need the CCIP for interoperability with their central banks, with their banking system, to actually access the stable coins. Now, it's very complicated, but that's my big thesis on it. Maybe I'm wrong. I think they're all going to need the Oracle network, the cross-chain interoperability for that, for tokenization to really be sustainable. And then zero knowledge proofs. Basically, what you want to touch on that for a little bit? What Chainlink is doing with zero knowledge proofs?
Yeah, zero knowledge proofs basically allow data that goes on chain not to be attributed back to a source. So you can think of you putting your social security number on chain for a loan, or you putting your driver's license to prove that you're 21 years old. That data goes on chain and the blockchain's public. What zero knowledge proofs allow you to do is allow the blockchain to have mathematic proofs that can say, yeah, this person is 21, but the data isn't present to everybody. And that's what zero knowledge proofs gives us. Chainlink's going to allow that, where anyone, any company can have, where they don't store the data. They're using a Chainlink zero knowledge proof. It's called Decode, where they can prove data about someone without that data being public and without it being owned by anyone. So think of that future where things are provable, but data is not owned by a single entity. That's Chainlink's research phase right now. This is about 1 to 2 years away. It's still in the testing phase, but if this may be a big deal where data can be proved about, any data can be proved about anyone, age, name, medical records, history, purchase history. It can be proved, but it's not owned by any single company.
Right. And the reason that's important is because I think in my view is that your data is basically your lifeline going forward, and for you to protect yourself in the future. And remember, investments aren't based on what they're doing now; they're based on what what they're going to do in the future, and the progress being made. So if progress is being made, then those investments or those assets are going to rise a lot faster. You don't buy Tesla because they do have, because where they're at now, you're buying Tesla for the future, what it becomes. That's why the NASDAQ, the tech sector, is outpacing the S&P by far, because of what it could be, what AI is going to continue to transform into. So same thing here with Chainlink. Now, the real big risk I think we're going to see over the next 6 months also is, and maybe I'm wrong about this, is AI deepfakes, right? Artificial intelligence deepfakes, one of the biggest risks to society, because you could basically fake a video where Russia is sending a nuke, right? You could fake that with AI. So we're going to need this. We're going to need this proof. Well, we have proof of reserves. Where does that fit into deepfakes? Is it just the infrastructure of Chainlink in general, like the zero? Is it the zero knowledge proofs that kind of solves that? And I know it doesn't directly solve it, but I've read a little bit on it, and I'm thinking about it like, hey, how else do you protect data, or how else do you check data to make sure that something is true on the blockchain? You're going to need, like, when it comes to deep fakes, how are you going to know if something is fake or not? I think you're going to need some type of mechanism to verify.
So think of companies that allow photos to go on their social media apps or their websites, and they have a requirement that says any photo that is added to our website, we are going to have a watermark of where this photo was generated from. So we know the source of every photo. So every photo on there, we know the source, that if that photo came from, a company, it came from Wall Street Journal, or it comes from, a journaling website, or we know if it came from an AI provider, if it came from an unknown source. So users could right away know, cryptographically prove that this photo is from a source that we don't know about. So you're very risky going through these photos also, just pulling these up for anyone.
Oh, shoot.
But yeah,
Okay.
but anyway, yeah, that's the deep fakes. Like if something's fake, we can right away know, oh, this data was never published to the blockchain. It's not verified. I don't, we're not going to trust this as true. So it basically creates, is there going to be a monetary use case for provability when it comes to deepfakes? If there is, well, it's going to involve probably oracles in the blockchain. If the monetary value is there, if users don't care, then there's not the monetary value. So it really depends on, is there a market demand for this type of thing?
Right. And I think the governments will need it no matter what. I think governments are going to need it first before even the people. So, yeah, so that's the thesis right there. And just keep in mind, at the end of the day, like, everything's going higher because basically the government has no choice. The governments have no choice but to keep pressing liquidity up. Liquidity goes higher as economies decelerate, not when they're already accelerated, when they decelerate. Our economy is decelerating. China's economy's been decelerating. Japan has been, so they're pumping. We're next. As long as inflation keeps collapsing, we're next. And we're already doing it. We're already pushing more liquidity. You just can't see it, which is why I made this, to show you guys that Fed net liquidity is turning up, and it's going to continue to turn up. So everything's going higher, and this basically sets up a big cycle turn, because we haven't seen this for a long time. We haven't really been at the bottom of a cycle and actually known it, right? The pandemic. Imagine if you would have invested in everything at the bottom of the pandemic, you'd be up so much. And that's kind of what I'm signaling here, is where the recession fears are not really there. They're starting to dissipate. They're falling apart because the labor market's still strong. The housing market's starting to recover. Manufacturing's still weak, but they're pumping fiscal policy infrastructure bills and all these other, Inflation Reduction Act, they're pumping technology type technologies, which is going to be Apple, Amazon, Google, Facebook, Tesla, and then the blockchain. They're going to be pumping liquidity into these investments so they can increase productivity, because that's the only way to grow the GDP without taking out more debt. And so that's really the takeaway here, is that we're going much higher, and I think markets hit all-time highs. So keep that in mind. What did you say here? We'll go through a couple of these questions. Could you explain the NASDAQ 100 a bit more? Because it went down. Do you think it'll go up next week? Well, the NASDAQ 100 is basically, when you're in a bull market, you're going to have a pullback to some degree, right? You're going to now this is NDX. I think what do you guys look at, NDQ? Well, either way, it's the same thing. And you're going to have a pullback at some point. So what you're really looking for here, you have all the moving averages in a bull cross. You basically are looking for support, the next support area. And I don't know if you guys have the same technicals as I do, but the lowest point, or that last support level for NDX is basically somewhere around here, right? So this is 1400. I don't know if you guys look at the Qs. 14.2, 14.3. It could pull back into 14.3. I wouldn't doubt that. But as soon as it bounces and it starts moving higher, sort of like here, sort of like when it bounced back here, it had a big upside move, and then it bounced off the moving average, and then it ripped higher off this bull flag. So we could see a bull flag come into play with NDX. I'm not sure if it'll happen, but we could see a bull flag. And you probably don't. I don't know if anybody actually looks at these type of patterns, but we could have a bull flag right into that support, right, and then bounce. And it's just, I think it's going all-time highs. I'm pretty confident by the end of the year, maybe even sooner than that, that we'll be at all-time highs. It's moved up so quick. There's a lot of resistance here at 15.2, 15.25, a lot of resistance. So maybe we do kind of shuffle around, but for the long run, we're going much higher, because that liquidity will keep coming into the market. The recession fears will keep disappearing. Now, when everybody gets bullish, that's where I'll be a little cautious. So we should have a pullback. We're gonna have a pullback at some point. And do I think it goes up next week? I don't know. I that's why I go live, because I have to look day to day, Yassine. I have to look day to day. I don't know if nobody knows if it's going higher or lower. The RSI tells us it should roll over a bit, right? It's oversold, but it is starting to have that pullback. So if we come back down to if the RSI kind of deflates lower, that's going to be your entry point. Not just the RSI, but your entry point is going to be like, okay, is it finding support? Is it consolidating? And is it moving higher? So keep your eye out for that. That next support here or another support is right here for NDX. So you have a lot of consolidation around here. But again, like I said, there's a lot of macro stuff that's improving. Watch the inflation report. Oh man, that's kind of in the way. But watch out for the inflation report. If inflation continues to decelerate, right, and that's what next is, that July. If inflation continues to decelerate and the Fed keeps their pausing rates, I don't think they rate hike again. This is going to rip. This is just going to rip higher. It's going to keep going up. So NASDAQ, I think, Bitcoin, of course, I think goes a lot higher, but that's a really tricky trade if you're trading Forex, because it moves so volatile. The NASDAQ's not as fast as far as I know. So just keep your eye out for those two. I'm not telling you how to trade it, but you definitely want to look for a big move higher. You don't want to like a longer move, not a day trade, not a week, but over the next 6 months. I don't know if you can set trades for 6 months on Forex, but over the next 6 months, this thing is going, once it finds support, it's going to break out and it's going to rip a lot. So we'll come back and visit this, but that's pretty much my thesis, especially when Bitcoin gets above this level that is trying to consolidate on, above the 32. I think it's 32,000 is the clearing. So keep in mind that. Yeah, if you ever want to schedule anything, just go to my profile on TikTok. If you want to schedule like a one-on-one meeting really quick, I have the schedule on there. But other than that, yeah, this is the macro report. I'm going to keep doing these each week, so you guys are up to date. What's changing in the market? The economy is still strong. I think markets go higher. Maybe this week we have a pullback and we support a little bit, but for the most part, it's we're in a bull market, and I think we're going a lot higher.
Yeah, let everyone know if you guys are on the TikTok stream. Let people know we're going to be streaming on YouTube next week. It may be a godsend for us, where YouTube may be the better platform to stream. But let everyone know. Let people know that we'll be streaming around the same time, and that we'll have better charts, and it's going to be a better stream for sure.
Oh, okay. So, but I'm a day trader. I think I should only be looking for buys, though. Yeah. For buys. Yeah. I mean, if you're buying higher. So you just look for support. I would jump on the stream. Yeah, see, just jump on the screen on the stream. I'm sorry, the live stream. I'll be on YouTube next week, like you said, and I'll check out whatever you're looking at, see if there's any support there. But like I said, day trading is tough. You could stick with being a day trader, but at the end of the day, you're going to make way more money swing trading something in an upside market because it's going to go up and down. So you're going to get caught up. But if you take all the noise out, we're going much higher. If you take the noise out, we're going much higher, right? You're going to sell, you're going to be a day trader. Like, let me just give you one example before we click out of here, Yassine. Because I've day traded too. I day trade. What you're going to do is say, okay, we have this big upside move, right? Let me go to like a smaller chart. You have this big upside move and you get out. So you have this big upside move. Maybe you got in here at this break of this pattern or this hold, right? So you get in, you have the big move, you get out, and then now you're trying to get in again, and then you mess up, you sold too early. But if you were to just buy and hold it for the bigger move, for the relief, right? For the relief from the bigger move, you're up a lot more. You had to do nothing. It's gonna have pullbacks and go higher. You might not like that, and that's totally fine if you want to just find certain trades. But for that case, I can't really guide anybody on a day trade. That's literally in real time. So when I do stream in real time, Monday through Friday, then we can check out, is there any support? Is there any way to get long something? But other than that, I do think personally, you hold it for the bigger move as the macro continues to improve. And that's really the big move. But if there's anything else I could help you out with, just let me know. All right, guys, appreciate you guys coming on here. We're gonna tap out, and don't forget we have a fitness live coming up too in the fitness mind growth TikTok. We'll still be on there today at, what is it? It's about an hour and a half from now. What is that? Eastern time, 7 p.m. Eastern. We'll have the fitness. So check that out on the fitness mind growth, and subscribe to the newsletter if you're not already subscribed.
Thank you. I appreciate it.
All right, Yassine, hit me up. Hit me up in the DMs on TikTok if you have any more questions. Catch you guys later.